Joining us now to discuss the markets, discuss some of his picks and perhaps what to look for this week when it does come to a huge slate of earnings. Michael Landsberg is Chief Investment Officer at Landsberg, Bennett Private Wealth Management, and he's joining us live from Punta Gorda in Florida. Thanks so much for being here, Michael. Just firstly, I look through your top holdings, I look through a lot of your notes, and all of this screams to me that you're of the belief that this is going to be a little bit of a short-lived bounce when it does come to the markets, or following on from what we saw in the Friday session, perhaps what we're likely to see coming through from the Fed. Is there any upside bias in your mind at all?
Not at this point. I think this is going to play out a little bit like it did this summer. We had, a very poor June. We rallied, July, August, and then we tested new lows in September, made new lows. You're having a little bit of a rally here. I think, again, short-lived. What's going on with the Fed is obviously the Fed's in a bias to raise rates, to continue to do that. The GDP numbers gave no indication that we're going to see a pivot anytime soon. And earnings are decelerating, across the board. Even when companies were telling you they beat expectations, they beat much lower expectations. And those numbers year over year are decelerating. So I think we're in for, a couple rough quarters. Doesn't mean you can't make money, but means you have to be real careful about what you're buying and importantly, avoiding certain sectors.
Which are the sectors that you would avoid right now?
We're pretty negative on tech. I still think tech's expensive. And part of the reason is tech had a good run for 3 years. And now you're seeing, basically across the board, all the big major, well-known, widely held stocks reported, pretty bad earnings. Most of them they're all decelerating. Few of them were looking at negative earnings, year-over-year growth. Apple kind of hung in there a little bit, the best of kind of a bad bunch. But even names, for example, like McDonald's, which we really like, is one of our holdings. If you look at year-over-year earnings, they did 286 a year ago. They did 268. The stock popped because the street expected 258, but it was still an earnings deceleration year-over-year. So those are the things that worry me. In spite of that, like junk bonds rallied last week, we'd still be short junk. Again, not liking technology, and we're short Europe. We think Europe's obviously got some problems. Inflation continues to get worse in Europe. At least in the U.S., we're kind of at like a high point, but we seem to be somewhat moderating. Europe seems to be continuing higher, and obviously a winter there could be really expensive.
I've got to ask you, though, because it seems that a lot of flow is coming back into the tech names when you do look at how some of the ETFs and the like are tracking. I know that you're short tech, but couldn't you make the case that now, it appears to be, for at least the near-term while, that the 10 years found a little bit of a ceiling at around about that 4 mark. You got real yields at around about 1.5, so it's come back somewhat, so have the expectations that, barring the Fed getting uber hawkish coming through this week, that there's a little bit run left to go in terms of these tech names to the up? Or is that your case, that deterioration is set and that we are going to see a hawkish tone and then the recession, or potential recession, I should say rather, impacting a lot of these tech names on a valuation basis?
I think to the extent tech is a broad asset class, has had a great run, but you're seeing kind of across the board that deterioration in earnings. And you could maybe be selective with a couple names that may work, but realistically, across the board, they've had great rallies. Now they're giving some of it back. Valuations are still pretty expensive, but also for where we sit is I don't know what they're going to actually earn. I mean, I look at businesses like Meta. They might be cheap, but I don't know what their earnings are going to be given the fact they've gone in an entirely different direction. What is ad revenue going to look like? So the PE is tough when you don't have an E. So that's, to me, an area I think you can stay away from. Simply because there's just too much cloudiness there. Why try to be a hero?
Michael, what about where you have an E? What about where you have an E? Even that is going down in the tech market.
So again, there's some names obviously we've held for a long time that, Apple being one of them, that you can hedge your position in terms of having some shorts in there. But I think the issue is establishing new positions when we're running into an idea. We don't know where earnings are going to be. The tech industry is laying off people. You're seeing that now, virtually in every company is either slowing hiring, reducing headcount, and that indicates that they kind of see that there's going to be a tough road ahead. So, to me, there's other areas that do better in recessions. I think the U.S. is headed into a recession, certainly a profit recession, and technology traditionally doesn't do well in those environments. So I'd stay away from there. I'd look for some other places that have more attractive valuations and a lot more transparency about what we're going to get from an earnings standpoint.
Michael, I'm just for all the investors watching, I'm just trying to understand your time horizons, because obviously if you're hedging against your tech positions by engaging in, the triple Q shorts, the S&P shorts. So are you investing or putting your money to work with the horizon of 6 months, with 12 months, or are your suggestions right now predicated on the fact that this is for short-term investors, people that are trying to maximize their returns and not necessarily set and forget?
Yeah, so our investment strategy is longer term. So the individual stocks that we own, oftentimes we're holding with the idea of 3, 5, 7 years. So when we're using some of the shorts to offset that, it's because we do like an Apple longer term. We just think, the horizon this year is going to be difficult. It has been. And rather than selling that stock and trying to figure out when we're going to time it, we've used those to kind of hedge and lower the risk. So we'd continue to do that. But the idea when we buy a position and go into a position, I'd like to hold it for a while. Be an ability to hold it for a long term, realize long-term capital gains. But right now it's very choppy. And so for us to go in and start adding to new names, we've been in a scenario where we've been defensive. We've sold some of the weaker positions in tech, and we've gone and said, okay, we like an Apple, but we don't want to necessarily be adding more to it now. I want to hedge that position. So we've been using the shorts as a way to hedge the positions out, with the idea that this is going to end at some point. But right now, obviously, we don't know when it's going to end. I think the Fed's going to be more hawkish than people think. Powell's been a student history here. And I think they're going to raise quite a few more times, higher than people think. And that's going to put pressure on tech.
That's interesting. Actually, the jury's out on that one. Every other guest who comes in Street Science has a different view on that. So we're still trying to make up our minds on which way the Fed would actually go on managing inflation. But let's talk about some of the names that you like, because you talked about profit recession. United Health. I wonder if this stock is over-owned in this market because it's done so well.
It may be to some extent. I mean, it's now the 8th largest market cap on the S&P 500. Part of that's because it hasn't fallen like some of the big tech. We just like its dominant position. Again, as a long-term holding, it's probably one of our longest holdings in the portfolio, coming up on nearly a decade. And we continue to add to it. We're buying it for new clients that come in the door today. So we like that stock because obviously the trends are there, and it's not trends for 6 months or a year. The demographic trends in the U.S. and healthcare are strong. They're in both, they're both in managed care. They're both in health facilities or provider. So very good margins. It is a well-owned company, but again, at the same point, they're doing all the things right that I think will continue to do well. And I don't see them, not staying as that dominant player, in the U.S. And there were some concerns a few years ago about managed healthcare and the government getting involved. That doesn't seem to be, I don't hear much talk about that anymore.
Right. And some of the other names that you like, really, that you're recommending right now is NextEra Energy, which is NEE, as well as Booz Allen Hamilton.
And NextEra is probably one of my favorite stories. It's got the kind of the new kind of wind and solar story, so it's a renewable story. But unlike so many of the renewable ESG stories out there, this company prints money on the other side of the ledger. They have a regulated electric utility business. It's a great story. It's in one of the best states in the United States to operate. It's in Florida, where people are moving in droves. And so they're not getting customer swaps. They're getting brand new customers. That's driving revenue to the bottom line. So we like that story because it's got the renewable story, but also, unlike a lot of those renewables, it's making a lot of money now. And we think that's very predictable going forward. Booz Allen, similar story. It's a small cap name. They're entrenched in the government. They do a lot of government consulting, which some people might say, oh, what if there's a government pullback? The United States and the federal government has never not spent a boatload of money on things. That's a customer that never stops spending. But what I like about their positioning is they're good in defense. They're good in alternate, in the AI space, but in particular, cybersecurity and cyber solutions, with obviously issues with Russia and Ukraine, with North Korea. There's a lot of things in the world that the government, U.S. government, has to take care of, cybersecurity being one of them. Booz Allen's in a great position to continue to get that business. And we've seen them expand kind of their wallet of the federal government and those agencies. So we think that gives us a good opportunity, again, for a longer horizon. They have a great CEO, been there a long time, and we think those are important things. During recessions, and that's where we think we're going to see profit recessions, you need to have good management. And all three of the companies that we just talked about have stellar management, good benches, good depth there, but great management teams that are, I think, going to be able to produce good returns during choppy times. That's really what we're going to see. We think we're going to see some choppy times, continuing.
Michael, lovely to have you on the show. Thank you very much for joining us with your thoughts and your insights.
Pleasure.